Welcome to Energy Unplugged, the go-to podcast focusing on the global energy transition. My name's Richard Howard and I'm Aurora's Global Research Director. In this episode of the podcast, we'll be looking at clean energy investment trends in Europe. Specifically, what I'd love to talk about is how the investor landscape continues to evolve in terms of investor appetite, deal flow, the market and technology focus, and how investors perceive risks to these asset classes. I'm joined by Jonathan Dillon, a partner at international law firm Clifford Chance. Jonathan's based in London and specialises in domestic and cross-border M&A for clean energy, renewables and brownfield infrastructure assets. He advises private equity, infrastructure funds and other financial investors and has particular expertise in competitive sale processes and the establishment of joint venture structures. Welcome to the podcast, Jonathan.
Hey, Richard. Great to be here. Thanks very much.
So maybe I'll start then, just setting the scene, and I'll pull out a few stats which I think are useful in terms of framing this, and maybe give a few views already on how we see the investment trends. And then maybe let's just try and navigate through a few of these topics. But to start with the big picture, I think the first thing to point out is that investment in clean energy assets has seen a massive kind of uptick in recent years. And just sort of summarize some stats on that I took from the IEA. In the late 2010s, across Europe as a whole, we were looking at around 90 billion euro per annum of investment in renewables plus grid and storage assets per annum. But since 2020, there's been a really sharp uptick, especially since the energy crisis. That number has basically more or less doubled to around 180 billion euros per year, which is actually really sizable even in a global context. That's about 20% of the global total after kind of China and the US as other mega regions. And our sense in Aurora is this volume of investment is definitely likely to continue for the next few years, with really strong push from governments, with strong targets for clean energy for 2030 and strong subsidy basis for a lot of these. So just in terms of between now and 2030, we see investment in the order of 330 gigawatts additions just of wind and solar, another 40 gigawatts additions of battery storage systems. That's in Europe between now and 2030. So hundreds of gigawatts of assets coming in. So it's a huge focus. One other thing that's quite interesting is the disparity between investment in clean energy assets and fossil fuel assets in Europe, which is very different actually to the pattern of investment in other regions. So whereas here, fossil fuel supply and power generation is rather the minority, in other parts of the world it's the inverse, and there's still heavy investment in those fossil fuel assets. So I thought it's kind of useful just to set the scene with those big picture numbers and that big, clear push behind clean energy investment in the last few years in Europe. But maybe to bring you in, Jonathan, what would be useful is to kind of get your take. So how do you see the investor landscape evolving and growing? So what sorts of investors are coming in? What's the typical sort of project size, return expectations? What are your views on this?
Yeah, sure. Look, and that intro was really helpful. I mean, the way I sort of think about these investment trends is that, economies are always growing, right? I suppose, except we're in recessions. And those economies and that growth is fueled by energy growth and energy consumption as well. In Europe in particular, that's been very much clean energy focused. But the demands on just simply, growth demand in energy through electrification, but also principally these days, decarbonization. And if we're going to throw another D in there, I think the really topical one is data centers and AI growth. But energy growth is just huge right now. And we're only seeing that going one way. And of course, it has to be financed through investment. So I suppose that gets you to your question to me is, what's the take on what that looks like? What I do for work is advise people in the private capital sector. And to maybe take a step back, I'm sure your listeners are largely familiar for this, but it's rather remarkable what's happened over the last few decades in the sense that we've had, this real meta trend of a shift from public markets to private markets. traditionally big projects, energy, that sort of thing was funded by big utilities or other big companies that were listed on stock exchanges. Today, increasingly, they're funded by companies that are either owned by some of the world's biggest private capital funds. So if you think of, Blackstones, BlackRocks, KKRs, Brookfields of the world, the capital's coming from increasingly from that space. And you're seeing this brought out in several different ways. I mean, if we think of the size of public markets compared to what they used to be, for example, in the US, I think there's a stat that says there was around 3,500 public companies in the US that were listed on stock exchanges. That was in the mid 1990s. Today, there's actually less. Now, we've got big companies on the stock exchange still, but the total number of them is smaller because of the growth of private capital. In the UK, for example, you look at the London Stock Exchange, it had a total market cap of around 3.2 trillion in 2015. And last year was about 3.8 trillion. So you've seen only very small amounts of growth in total market capitalization for public companies in the UK. But at the same time, you've, probably doubled, if not tripled, the amount of private capital in that space. So that's really the story, I think, in the background to all of this. So I see the story at the moment of, massive shifts of private capital investment. I can pause there, but I guess the other factor that's happening alongside this is governments investing less. But I can pick up either of those, Richard, that your listeners might find interesting.
Yeah, I guess personal reflection and experience in Aurora has been very much in line with what you've just said about the shift from companies funding things through their balance sheet or through corporate debt. It's like the publicly listed companies. I remember in the early days of Aurora, I've been here nearly 8 years now, and a lot of our early clients were the likes of SSE, Centrica, RWE, it's like some of the big European utilities. But now increasingly, well, that's been complemented, I guess, by a raft of institutional investors, infra funds, banks, and also a plethora of other sort of smaller developers as well that come alongside. But so the utilities are still there, and they're still doing projects. And that's one part of the puzzle, but that's complemented by such a range of other different investor types alongside. So definitely fully agree with that. What are your views on kind of what does this mean? This sort of shift, increasing focus and entry of big infra funds. What does it mean in terms of what those types of investors are looking for from a project? So, for example, ticket size. What gets those big investors interested?
Yeah, I think so. So to start with ticket size, I think that is a big factor. These funds often invest at scale. If you look at them, and we speak with them frequently, they're investing amounts that are in the tens of billions annually globally. But often, their infrastructure team might be sort of, 10, 12 people, 10, 12 investment professionals, right? So for them to achieve the returns that they want, they typically invest at scale. These largest funds that are investing, that have basically assets under management sort of in the multi-billions, they're looking at ticket sizes that are often 500 million plus. So if you're thinking in the renewables context, that probably means they're not buying a single wind farm or a single solar park or a single developer, for example. They're looking to invest in platforms often that might be multi-technology, multi-jurisdictional, and a mix of operational, generational assets combined with sort of a pipeline of, development assets. So at scale, basically, is what they're looking for ticket size. And that means that their requirements are often quite specific in that way.
Yeah. Again, kind of a reflection. Wholly agree with that. And it's hard to separate what's going on in the market from what deals Aurora is involved in. Like I see the upshot of the deals that Aurora's involved in and try and infer what's going on in the market in general. But we've definitely seen larger and larger transactions where we're acting as some market advisor. And just to give a statistic, last calendar year, so 2024, we were acting as a market advisor. In total, all the transactions involved globally was about 21 billion euros, but most of the largest and most numerous deals were in Europe, so it's nearly 20 of that 21, 22 billion. But some of the projects are vast, so sort of gigawatt scale or even bigger financing of portfolios of assets, typically sort of wind, solar, batteries are the main focus, but there's multiple different projects like that now that we've been involved in, and I think sometimes alongside yourselves in the same projects. But it does seem to be, there's these sort of massive scale projects, obviously a lot of smaller ones as well, but there's that emergence of these very large deals.
And I think the energy transition, obviously, to get the sort of economics that investors need those economies of scale, right? And we've seen it in technologies like offshore wind, for example, that, to go from, those smallest projects, which, when we're talking about a couple 100 megawatt being, unthinkable sort of 10, 15 years ago, to now, I think you look at Hornsey 3, which, is in the pipeline in UK waters, and we're talking sort of 3.6 gigawatts. I think it's around that for a single renewables project. I mean, the scale you get from that, that's powering millions of households. That's how, I guess, the energy transition is working today. We're needing to do it in big numbers to get the efficiencies and get the economies that get returns for investors.
Yeah. Is there, just on that, like we talked there, what you're mentioning there is a single massive asset. What we were talking about before was maybe portfolios of large numbers of smaller assets, let's say. Do those institutional investors get worried at all about that kind of single asset focus in the case that you just mentioned, or is there a preference towards the more diverse portfolios in their book?
Yeah, I would agree that diversification is often key for these investors. It's not to say that the largest infrastructure funds haven't invested in offshore wind and haven't invested in single projects, but it tends to be less the norm, I think. We see a lot of these big funds investing in offshore wind. Some are doing so, on a diversified basis. So Brookfield invested in a portfolio of 4 wind farms recently when they invested into the UK. But many of the largest funds haven't yet properly put their toes into offshore wind as a technology simply because of that single asset risk. But like with lots of things with energy investment and energy transition investment, I think we're seeing innovation, both from a financing perspective, the way that developers and others are setting up structures to try and make it, palatable to private capital, because there is such that need for capital and so much, I guess, untapped potential for private capital to invest in this space, that if we can make it work, generally someone's going to try and find a way to do it.
Yeah. Thinking about that diversification piece, but in a different way, what trends do you see in the geographical markets that these very large institutional investors are looking at, both kind of within Europe, which are the emerging hot markets now maturing quickly that weren't there a few years ago, and how do people think about a broader global diversification?
So global diversification is certainly there. There are definitely global renewables platforms that have the attention of financial investors and funds, and they invest through global funds that raise capital globally. They have global mandates. It makes sense for them to invest in these sort of businesses because they do naturally just give that level of diversification, in the sense that you might have mature markets, you might have growth markets. You get sort of the lower risk, lower return from those mature markets, but then in growth markets, you can accelerate that return, and that diversification is great. Like, investors love that generally. But for renewables, historically, it has been quite jurisdiction specific because we have different regulatory regimes, we have different subsidy regimes. Some markets have been ahead of others in that sense. The UK was an early leader in Europe, for example. Western Europe is relatively mature. Spain has seen huge growth, for example, in solar in the last couple of years. Other markets are now only starting to see investment at scale. Central and Eastern Europe, Poland's getting quite a bit of attention at the moment. Romania, Bulgaria are newer markets, but all are seeing that sort of investment. And to be honest, the private capital and the funds market is almost diversified enough that there are players who will want to specialize and get exposure to all of those different markets, depending on what product they're selling to their own investors.
Yeah, in fact, so we've seen the exact same thing. So again, trying to separate market trends from Aurora trends is slightly difficult for me. We've had a long track record of supporting transactions in markets like GB in Germany, where we started out a decade or more ago, France, Iberia, Netherlands, but now more and more activity in markets like Poland, Italy, Nordics, Greece, Bulgaria, Romania, you mentioned as well, Baltics. So there does seem to be more and more interest in some of what I think is going on there, but tell me if you think I'm wrong. Because some of the more mature markets have become so competitive and see so many investors, and potentially there's even concern about saturation risk in some of those markets, those same investors then start to look at other markets within Europe and say, hey, what about Greece? What about Romania? What about Poland? Could I get a higher return there now if fewer people are willing to go there yet? Do you think that's part of it? Is kind of people wanting to have a first move, sort of take a bit more of a risk in an emerging market?
So if I compare, say, today versus 5-10 years ago, there are far more funds and investors who are looking at jurisdictions like Romania, Poland, Czech Republic, Bulgaria, Greece, the Balkans. The number has gone up massively because those markets, as you say, can often provide better returns because they're less mature markets, there's less competition for assets. And also they've been able to develop their own regulatory regimes and subsidy regimes to give investors confidence to invest in those markets, whereas, hadn't done so as early as other more mature markets in Western Europe. The other thing to remember is, of course, that, to build an onshore wind farm, you need land. You need solar resource if you're going to build a wind park. And there's only finite land and sort of wind and solar resources in other parts of Western Europe. There is a lot more untapped potential geographically in these places. So I think investors are seeing that. But I'd sort of caution to sort of say that, all the investment is suddenly just going to go east in Europe, because I think the reality is there is still such appeal for investment, albeit in slightly different places, be it sort of grid, be it newer technologies, be it just simply meeting demand growth in other ways in mature markets still. And I don't think we're in any way seeing a drop-off investment in those more mature markets in Europe. I think it's just a bit of a shift more generally. And I think the pie is just growing more generally rather than, more mouths trying to eat the same slice, if that makes sense.
Yeah, makes total sense. And I want to move us on and start talking about kind of the technology landscape as well, sort of what technologies investors are interested in now, maybe with a focus on which of the technologies that investors would consider looking at now that they weren't a few years ago. So what's the wave coming now? And then what's the next wave where people are like, oh, okay, not quite there yet. We'll look at it in 2-3 years. Just taking that kind of first bucket. Yeah, what are the things you would say have emerged in the last couple of years where you're like, okay, yeah, this is solidifying now?
Yeah, so I think the thing that's been really quite remarkable in the last few years is just how mainstream renewables, so wind, onshore solar, and to a large extent now battery has become, really mainstream for so many of the fund investors, whereas before it was still seen as attaching a fair degree of risk attached to it, or seen as something that was the purveyor of utilities or, other different types of investors. And in particular, funds being able to direct capital towards both development and construction risk as well, I think is the other thing that's really become a lot more mainstream, whereas, that just simply wasn't the case 10 years ago. And the way that I think that's happened is that, as I mentioned before, platform assets, if you're buying, a bunch of, operational wind or solar parks, it really suits the investor profile because they tend to be sort of long-term contract based, either with long-term PPAs, long-term subsidies. That really works well for paying people's pensions. It's quite conservative. It gives the sort of risk return profile that people want. But what's happened is those assets have been bundled in platforms with development assets, which do have construction risk, which do have development risk, which sort of aren't the things on a standalone basis that, are good for pensioners because they're too risky, basically. But if you combine them and you do so at scale, you get an ability to, I guess, juice up the risk return profile slightly, give a bit more back to pensioners. And it is those pensioners who are sort of ultimately invested in these, global funds. So I think that's been the real transformational thing recently. In terms of what's ahead, does that mean that you're seeing, private capital plunge into hydrogen right now, or, writing multi-billion pound tickets for CCUS? The answer is not quite yet, because we're not quite there yet in terms of delivering, longer term contracted kind of investment returns from those type of investments. Will that come in the future? Potentially. I think we're all expecting to see that at some point, but it is a slight question of when, and those technologies do need to mature slightly. The economics around them do need to, I guess, work themselves out, and the use cases for those new technologies just also have a little way to go.
Yeah, I definitely agree with a lot of what you said, especially the sort of bundling in of development risk projects. I was interested that you bundled in battery storage as well in the same breath, or the same category. I mean, I remember Aurora's had a sort of series of battery conferences over the years, which is a good sort of bellwether for me of and my take from those various events of how people think about it. And I remember going back a few years, pushing a few, and it's a different source of capital, but project finance bankers to say, hey, would you project finance a battery? And a few years ago, the answer was just no, let's watch the space. And then all of a sudden it kind of flipped not that long ago, actually, to do project finance, and also institutional investors coming into the space and say, yeah, we will look at batteries, and increasingly we'll look at batteries with a lot of merchant risk rather than heavily contracted revenues. That has been a real shift in my mind in the last 2 to 3 years. It's gone from being not possible to possible, and then happening at scale in mega portfolios, as you say. So that, yeah, to me, that's been a big shift.
I think there's been a massive mindset shift around this. I'd agree completely, and I think I wouldn't say out of nowhere, but sort of intermittency issues with renewables have become acute. Grid issues have become acute, not least because of data center demand growth, among other things. And the time for batteries seems to have arrived with us really quite nicely in that sense. And we've gone from that position where I think people have seen them as, risky, very heavily merchant focused. And to some extent, they still are. But where you're combining them with existing portfolios, I think, and people I think are realizing just such a key role that they're going to play going forward as part of our future energy systems, that it is for many just a no-brainer to have batteries as part of the mix of a standard renewables investment portfolio.
Yeah, and there seem to be two ways of thinking about that, which is slightly separate logic. One is around a portfolio play, where you say, okay, if I've got renewables with intermittency, but then I've got batteries alongside in the same portfolio, but not physically on the same site. So that's one play, and definitely see a lot of cases like that. But increasingly, co-location on the same site. You mentioned grid as an issue, and was definitely going to bring that up as well. I mean, we see that becoming an issue pretty quickly in a lot of markets, and hence why we do more grid analysis these days in European markets like Spain, like Italy, like GB, and some others coming up. That is becoming quite an acute issue. We've gone from investors not really asking us about that even 1 year, 2 years ago. It's not really a topic that was coming up too much, grid curtailment, but all of a sudden became a reality in Europe and got quite a lot worse quite quickly. And we started looking at that more and more. And increasingly, it's becoming a kind of go-to, like, yes, we need to have the grid analysis alongside the economic analysis, please, Aurora. So that is what we look at more and more. But then in response to that, we see so many more projects where the developer tries to internalize that problem by co-locating the renewables with battery and trying to deal with the intermittency, but also deal with a constrained grid connection and make sense of that from an economic standpoint. So yeah, definitely an interesting one that's moved pretty fast. Yeah, you mentioned hydrogen and also data centers. I'm keen to dig into the data center side, or we could probably talk about so many different technology classes, but data centers is coming up quickly as a topic again everywhere, but in the markets we look at, especially in the US, in some European countries more than others, I would say, and in some of the APAC markets we look at, it's definitely a strong focus there. Sort of, what sorts of transactions are you getting involved in, or projects are you getting involved in that space for data centers, and what sorts of what are the key questions that investors are asking themselves on your part?
Yes, I guess just to distinguish sort of how we look at this, I mean, we act for investors looking at data centers specifically as their own asset class. And I guess as someone also who invests in or helps people invest into energy, people very much focused on the impact of data centers on the energy landscape more generally. In terms of the first, I think the scale and size of which new data center projects are being announced is just remarkable at the moment. We are just seeing so many come across the desk all the time. We have expanded our own teams. We know our clients have expanded their teams, all just to kind of satisfy this need, which I think, you read varying different numbers, but between today and 2030, people think, total data center size combined, it'll triple within that time. All of this fueled by, the AI boom, increasing need for cloud resources. It's boom time for data centers. There's no doubt about that. What sort of deals are we seeing? Again, the economies of scale are really starting to take play here. So financial investors investing in the tens of billions for single projects in places like the UK, in other places around the world. We're not seeing where those data centers are being located, necessarily be just next to big population centers. Often people are now thinking about where can we build these where we'll have the right access to energy as well, becomes very much part of the equation. It has such a huge focus at the moment and is seen, as so critical by so many of the big funds that there's very few of them who aren't paying attention to it at the moment. Yeah. So that's one side of it. And then the other side of it is sort of as an energy investor, I guess, is the other way to think about it. And it's two. I mean, I guess there's the opportunity in the sense that it is fueling demand growth for energy, which just means we're going to need more generation more generally. And lots of energy investors, private capital and elsewhere, just being seen as facilitators to help these data centers get built. But then the challenges that come with it, supporting the grid with that growth, making sure that, is it more important that we're providing power to a data center or, ensuring people don't get blackouts, right, in terms of how we prioritize grid? It overall means we just need more grid investment in most places in able to support this. So I think it's really multifaceted in terms of how we need to view data center demand growth, but it is getting everyone's attention at the moment is I think how you'd summarize it.
Yeah. And what I find challenging kind of analytically and sort of following it as a topic, but analyzing it, is how to kind of cut through. There's a lot of hype around this, and it's like, how do you cut through that and actually think what is the real stuff from the hyperbole that comes with it? It seems to me, I mean, it's clear that there's a lot of power usage in data centers. Like, not going to argue with that. Although if you put it in a global context, it's 1 to 2% of global power demand at the moment. It happens to be the bit that's growing the fastest. And I think where it becomes more of a challenge, but also very interesting, is tends to be a very localized form of demand. It's very, very concentrated in some specific geographies and in some specific asset, like hyperscale assets, and in then clustering of those assets in particular geographies, which can put immense strain on grids, literally to get those electrons to those sites. And then there's this kind of added dimension, as you say, the tension between serving those users off-takers who demand completely stable, firm power, and ideally green as well, alongside other types of users. But the data centers probably have the highest willingness to pay of anyone. And how do you balance that and make sure that it works for society, for economy, for the grid, in all these different dimensions? That does throw up quite a set of challenges, I think, to navigate, both as a data center operator owner and also as a power provider to those off takers. It is a pretty challenging thing. What I find quite interesting in Europe, there's definitely a top tier of locations that have come through. But some of them have been actually established as data center locations for a while. The very unfortunate FLAP-D acronym of Frankfurt, London, Amsterdam, Paris, and Dublin. And there definitely is there is that top tier, but I think partly because of grid constraints, Dublin, it has become very saturated, and the government and regulator there has slowed things down. And you start to see secondary locations coming up quite fast. For example, Madrid and Spain more generally, has abundant renewable power, and there's some demand for data centers there. Land is more available and probably cheaper than it would be around London, for example. So there is this kind of saturation or cannibalization of the opportunity in some places, and then it sort of pops up somewhere else, just in pragmatic terms, once those first tier are a bit more saturated. It's going to be really interesting, I think, to follow that. And kind of analytically for us in Aurora, it's when you're trying to run a grid forecast for one of those markets, and the demand sort of keeps on moving around to different places. That's a bit of a challenge analytically, let's say. Even just getting the handle on the data of where are these large units kind of located, that's, even assembling that takes a bit of effort, and then got to build that all into our grid analysis. But we're getting there.
Yeah, and I agree with all that completely. It's changing by the second. I think if we think in the context of the energy transition, some people sort of say, well, is all this demand growth going to data centers to fuel AI? Is that taking a step backwards with the energy transition? Some people will have that view. I think the interesting one to think about, though, is using AI as a tool to help us with the energy transition, right? And we have such complex problems to solve with energy networks, the energy transition, how we're going to modernize our grids and transform our, energy delivery, our electrification of our economies. AI is clearly going to be a tool around all of this, right? So in a sense, while it's, taking power away and taking energy away from other sources, at the same time, I think it has the potential to be a force for good around this too. So it's impacting in lots of different ways. It's a really interesting one to watch.
No, 100%. I mean, without giving too much away, Aurora is going through that transition itself. It's always been a data-driven company, now a software-driven company, and increasingly AI-driven company as well. So we see it ourselves on a day-to-day basis, just trying to think through how can we harness that technology to improve our own efficiencies and around what we do. I just had one other sort of topic and then we can kind of wrap up or start to wrap up. Just interested in sort of how investors are navigating some of the geopolitical topics going on at the moment, which could be perceived as quite risky or adding some volatility. I suppose what I'm referring to here is Trump coming in as president and starting a sort of a trade war, increased tariffs with really most of the world, and retaliation around that. And we have multiple major wars going on around the world. We have a rise of China in all of this in retaliation with Trump. That's a lot going on all at the same time. To what extent does that create fear or put off investors in the sorts of investors that you're talking to, or are they just used to riding out these sorts of issues?
So a few thoughts on this. I mean, most investors don't like uncertainty. They tend to approach their investments with trying to be rational about all the various risks that are happening, to try and build an investment case. because effectively, they're fiduciaries for people who they've taken their money, and they want to be able to say, we're not just treating this like we're gambling. We're going to look at the risks, analyze them, and do so in a way so that we have a really good chance of, giving you a good return on your investment like we, said we would. Uncertainty, and in particular policy that is shifting very rapidly, makes that a lot more difficult. So without talking about any one jurisdiction or otherwise, there's just a lot changing at the moment from a policy perspective. And I think most reactions to that from investors will be, maybe it makes sense just to wait and see for a little while. So I think our expectation is that we might see a bit of a slowdown in things like M&A activity. We might see people defer FID on projects until they know what the policy environment's going to look like, or, from where and for how much they're going to source their products for solar panels or turbines or whatever it might be. So I think generally people will be slightly hesitant, at least for the time being, until things calm down a bit. But that said, I think there's some competing and counter narratives to that. The first of which is that there are some investors out there, in particular the ones who can invest, at the biggest scale, who will see opportunity here. They will say, while others are hesitating, it's a real buyer's market. There's bargains to be had. We can look at fundamentals. We can weather this storm. We can diversify enough. Let's chase that on that basis, and they'll keep things moving. And, there's examples in the market still happening out there around that at the moment. We're going to continue to see more of it. The other counter narrative to all of this, and this is particular to the private capital context, is this idea of dry powder, which gets thrown around. This idea that investors give, like pension funds of the world, big investors of the world, give their money to, infrastructure funds, private equity firms, to then go and deploy by buying assets. That money, while it's waiting to be deployed, is called dry capital. Effectively, private capital works like a bit of a conveyor belt, in the sense that it gets money in the door from its investors and it's got to spend it. There is still trillions of dry powder out there waiting to be invested by these firms, and they can't sit on it forever. So that hesitation to invest can only wait for so long. People will need to be creative and work around the policy environment to work out how that money can be invested and returned to investors. And in the energy context, the climate change doesn't wait for recessions. If that's what we're working into, it's still got to happen. Electricity demand growth is still very much there. So that investment needs still going to be there. So I think in the broader scheme of things, we're going to basically see much of the same.
Yeah, no, definitely some opportunities for those who can be bold. It's fascinating talking to you, Jonathan. I just want to end with one last bit. We often wrap up our podcast with a section called underrated or overrated, where I just throw a few ideas, concepts, or technologies at you and get your gut feel reaction. Is this thing overrated or underrated? You can justify the answer if you want to.
Yep. Okay.
You don't have to. Okay, why don't we start with long duration energy storage?
I think underrated. I think we have not focused enough on just how much this is going to be needed to make our intermittent energy systems over the next decades work properly. I think, and I'm going to slightly extend this slightly, but bring in gas as an underrated thing. People may not think of gas as sort of a long-term storage solution in that way, but the UK in particular has used gas to effectively import to sort of top up demand needs when it needs to. And I think in the immediate term, until technologies built out or clean technologies are built out for longer duration storage, gas is probably going to be part of the solution around all that in the near term.
Yeah, and actually we're going down a rabbit hole now, but interesting how the financing of that in a European context, I think, is becoming quite challenging. There's fewer and fewer, in my view, investors who will actually touch gas assets these days. Would you agree?
Well, yes and no, actually. I think there is some who are increasingly constrained by their mandates in terms of what they can and can't invest in. However, in terms of demand for gas and investor interest in gas for those who are willing to play in that space, I think we're seeing a bit of an uptick at the moment. So
Uptick.
it's a slight tale of, two worlds there, I think, in that those who are going to play in gas, I think they're going to see opportunity. And I think a lot of people are predicting quite a bit of demand growth there.
Yeah.
Rightly or wrongly.
If indeed they can buy the turbines from anyone. Let's do one final quick one. What about geothermal energy? Underrated or overrated?
I think overrated, not in its sense as a useful technology, but just in terms of the amount of resources available to us and ability to scale it in the right places.
Okay. Jonathan, it has been fascinating talking to you. Clearly at the cutting edge of a lot of these investments and deals and working with some of the largest players around. So yeah, really fascinating. It's been a great chat. We could talk for hours, but we will wrap it up there. So thanks very much for coming on the podcast.
I've really enjoyed it, Richard. Thanks for the time. And I hope to listen more as well, but good to chat today.
That was Richard Howard, Aurora's Global Research Director, talking to Jonathan Dillon, a partner at the international law firm Clifford Chance. Thanks for listening to Energy Unplugged. Do keep an eye on our podcast feed for more in-depth conversations with senior members of the energy industry. The best way to do this is to follow the podcast via whatever platform you use.